The Johannesburg Stock Exchange, JSE Ltd, operates Africa's largest exchange. Market cap here of 11.4 billion rand, price to earnings ratio 12.4, dividend yield of 4.3%.
Let's start off by putting up this share chart, because I think we all know what the JSE is, we know what it does, but what we need to talk about is that unfortunate slip there at the end, which I think relates mostly to an earnings disappointment in its most recent set of numbers. So
and what about the competitive environment, the changing landscape that again is, let's just say, opening up pretty rapidly?
I'm not too concerned about that. I think there's another exchange that's been licensed at the moment, which would theoretically be a competitor to the JSE, but I think they've just got one share that's listed there, Senbes. So so
it's going to take a long time to build a credible platform.
I don't see the big counters on the JSE, the likes of your British American Tobacco, Naspers and things, finding a need to go and list on a separate platform, because the existing platform that the JSE offers is pretty robust, and it reaches a wide audience of investors anyway. So unless the new exchange can get some big companies, even offshore companies or offshore listings, it's hardly going to touch the JSE's market.
So the downside pressure is not a result of changes in the competitive landscape, but rather the earnings disappointment.
Yeah, I think for those competitors, I agree with Nesan. It's going to be a bit like saying, well, we've launched a social media business and we're going to compete with Facebook. Well, good luck with that. As far as this slide is concerned, I think it was because at the interim stage and in previous periods, the JSE has always just done spectacularly well. It's made lots of extra money from its equity trading business, its bond trading business, its futures trading business, its commodities trading business. It's been able to lower costs, but yet it just seems to carry on doing well. In this most recent set of numbers, the earnings and the revenue were roughly flat. Costs had risen somewhat because of salary and other adjustments and IT spend on BDA and upgrades and other trading engine upgrades. And suddenly, for the first time, people thought, oh, I wonder if we haven't gotten a little bit excited about the values. And of course, it is at the end of the day a business which is at some risk in the long run from changes in the structure of markets and trading.
Long run being the operative term in that discussion. Anything else to add before we make a call on this one?
Yeah, I think there is going to be periods of time when costs are going to overrun revenue, especially when you're changing your revenue model and you've got all these IT costs that come in. But I think it'll work its way through the system.
I was actually quite surprised that the share price has come off as much as it has.
Is it a buying opportunity?
I don't know. It's a funny one, because if you look at who do you think owns the biggest stakes in this business, it's the PRC, the government, employee pension fund. There's some other kind of holdings of that nature. There's one foreign fund, which is an emerging markets fund. There's a bit of this, a bit of that. It's quite a strange looking equity structure. It's not really a mainstream type stock. I think Coronation has got a fairly significant investment in it.
So having said that, I'm going to ask you again, is it a buying opportunity? You said you don't know. Hot, not hot?
Look, market turnover is key to them, and showing that they can deliver cost discipline a little bit more than before. So I'm going to pass for the moment.
Not hot.
Not hot.
I think, for a business like this, which is really a monopoly, 12 times PE ratio, 4% dividend yield, it's hot for me.